our investments and being part of the Spartan family. If you have never invested or you just invested with us first time, Foliage has been such a great part of what we've done, and in a lot of what we bought in 2025 and 2024 even, it wouldn't have been possible without the members. So thank you for that. And I think this really gives us an opportunity to dive a little deeper into what's going on outside of our normal monthly investor updates, which we send out to everybody. If you feel you're ill-informed or don't have a link to your investor updates, we put that out every month, and we put out a little blurb about how the industry is progressing and what we kind of feel is going on in the market. So if you're not getting that, let us know so we can do that. But we wanted to have sort of more of an exclusive private investor update with the members here, and I've curtailed the information to mostly be about the deals that Foliage has done since connecting with us in roughly early 2024 to mid 2024. And so a lot of these deals are just focused on that. I know that Steve and Jonathan have invested prior to some of the deals that the Foliage Group has done, and I don't really talk about that. But what I'm going to talk about today is just the deals that that Foliage has done with us, and then also I'm going to talk about just some high-level findings and observations from the self-storage publicly traded REITs as well. So if everybody can see my screen, I'll go ahead and get started. So first of all, this is a look at the Spartan portfolio nationwide. So right now we have about 82 operating assets. We have several assets that are being built or not quite online yet, but we view that there's about 82 assets in our portfolio, and this is kind of how we break up the country. And you can see that our biggest footprint is in the South, followed by the Pacific states, and then by Texas. So as a region, that's kind of the way that we look at it. And then we also measure our same store performance change year over year, and we've used these numbers year to date. So this is January through September of 2025, comparing last year's performance. And you can see that with few exceptions, we've really grown our NOI year over year on the right-hand column, with the exception of the Midwest states, which is primarily focused on the Midwest, just our three Wisconsin assets. So overall, we have about 43,000 units now. We have about 5.7 million square feet in service, and we're operating across 15 states. High level in the portfolio, we've been more aggressive on marketing with a Google review focus, organic search engine optimization focus, and our website in the quarter has increased about 14.9%. We're spending about 32 cents per square foot in our portfolio, which is in line with industry standards. And our average cost per lead, this is a lead that doesn't convert, just a lead coming off the internet, it's about $92. And our average customer conversion cost is about $150, with a lifetime value of a customer right around $4,500. So our average stay right now is about 32 months, and we've been doing a pretty decent job with focus on Google reviews, which is really leads into better customer bookings and experience of the properties. So now just talking about the market. So the self-storage market has been relatively challenged over the last 3 years we're talking about as an industry now. It's the rental rates have been in decline, but that's been easing. So in 2024, we saw about a 1.2% decline in rates. We've seen the decline improve to about a negative 0.7%. And we've also seen a return to normal seasonal cycles. So if you're not in storage and you're brand new to this, from about August through January, that's our slow season. And then from February to July, that's our sort of our leasing season. And that typically follows the trends of people moving. So people tend to move and buy houses and uplift their life during times of the year that's more in line with school season or changing jobs or the summer cycle. where in the fall, people get back to sort of doing business trips and things like that that don't create a lot of self-storage events. The most metros are improving month over month in rates, and so you can see the trends here on certain markets. You can see the increasing trends starting at Vegas, going all the way to basically Atlanta, and then some of the negative trends from Chicago down through the Denver metropolitan service area. So Sunbelt traffic is really good, and that's been steady through Q4. And then this is just some of the other things that we're looking at. This is what rents are per square foot in the major metros across the United States, and just some observations, right? This is just publicly traded self-storage data that comes out and is available to us. And the takeaway we have here is we've had some of the first year-over-year rent growth, and after 3 years of declines. So that's up just about a percentage. And the national average rate for a self-storage unit now is about $16.80 per square foot as of September, which is pretty good, actually, in some of the major metros. Houston, we saw that right around $28, $29 a square foot. In markets like Corsicana, that's around $12. Climate control is up. Non-climate control is up year over year. And, with the REITs leading the changes, about 2.6% year over year growth versus about 0.1% for non-REITs that are operating in the space. And then one of the big threats to self-storage is supply and development. So whenever you enter a market, the number one thing that you want to know is anybody really building behind me? And is there enough demand in that market to withstand any saturation? So 50 million net rentable square foot under construction. That's about 2.6% of the total inventory. And so deliveries in the last year have only grown about 9.4%, which is we've seen that as a decline in the number of projects actually being delivered in a market. And we've also seen absorption. So in the Sun Belt, we've seen that anything that was built in 2022 and 2024 has been absorbed or been filled up. And then the PNW is probably the best market in terms of saturation. So when you look at the Pacific states, we've seen these markets have the highest occupancies and the lowest new developments. So that kind of plays into properties like Bellingham and Oak Harbor that we recently delivered in 2025. So we're seeing these markets as being mostly undersupplied, well-occupied markets. So just kind of a recap. This gives you kind of more regional performance in some of the markets that Spartan is in. In the Southeast, we've seen growth year over year, about 4%. That's Tampa, Atlanta, and the Carolinas. So that's things like our Havelock facility, our Beaufort location, our Hudson facilities, Ocala, things like that. And then we've seen Texas market stabilizing to flat, so about negative 2.3% growth. And then we've seen, the PNW kind of growing at a steady 1 to 2% growth. And we've noticed that if we're diversified within these markets, it really gives a nice balance to our portfolio. This just kind of gives, again, just self-storage REITs and REITs trends. The biggest takeaway here, though, is self-storage is remaining resilient. It's remaining recession resistant, even at a time when people aren't really moving and they're not changing jobs, they're not relocating, they're not downsizing. We're seeing self-storage really doing a good job performing. So now I want to transition to just really quick overview of the Foliage member assets. And so this is anything from, say, Port Wentworth through the Houston assets in timing. So that's about May of 2024 through today. And so overall, those assets, occupancy is stable or increasing across the portfolio. Move-in volumes are going up. And so we're seeing a lot of, as far as renewals, we mean like length of stay is good. And then distributions have all been consistent with what our expected pro forma. And then we've really seen the benefits play out in the strong performance with the operators. So places like the Northwest Arkansas portfolio growing, $15,000 a month in NOI, or the Eustis facility already being, over 50% leased. We're really seeing good, strong operations with good markets are really driving a lot of the performance. Okay, so I wanted to kind of get into Port Wentworth. That facility is coming online next month, and we expect units to start being leased in 2025, which is going to provide us with bonus depreciation, cost segregation for the tax year 2025. So pretty excited about that. Port Wentworth is one of the fastest growing cities in the state of Georgia at 4.1% population growth year over year. It's super high. And then just a couple of things to note in the market. There's a 150 acre sports center development that's happening within Port Wentworth. A lot of housing coming in, facilities, restaurants, retail, and this site is really it's a 4-minute drive away. So there's a lot of development still happening in the market. And the Eustis property has surprised me, quite frankly, a lot. But when you kind of dig into the market fundamentals, you'll see why it's been performing so well. There's been really consistent month-over-month occupancy gains. When we opened the facility, I think in the late May timeframe, early June, we were renting anywhere from 20 to 50 units per month. And if you remember, the reason why we like this asset so much is because there wasn't any other properties around Eustis that actually had zoning approved for self-storage. We were sort of the last property in that market to get zoning, and so this really has contributed to having a high barrier to entry. Here's a couple of talking points on Eustis. You can see the growth and occupancy, and this is some of the metrics that we internally review. We call this our quad reporting. On the top left there, you can see our year-to-date revenue and expenses, and then on the top right, you can see some information about unit occupancy and rents per square foot and where the market is at. And then on the bottom left, you can kind of see the gain or loss and on our coming right off of our P&L. And then on the right-hand side, it's sort of our recommendations and sort of notes about the property. So I want to point out that if you look at the top right, you can see the dashed blue lines, which give our market per square foot. So you can see that what we're doing right now is we're leasing up the property very rapidly, but we're doing it at a significant discount. So we're discounting units to drive our occupancy to the 80% range, and then we're going to be raising rents after that. So overall, like ECRIs in the revenue management bottom quad, you'll see there's 0 ECRIs year to date, and only 1.1 or $1,100 planned for the remaining of the year. Basically, that means is that we're not planning on any rental rate increases really on the customers that we have in the facility, because we want to get it to full occupancy before we start doing that. So that's pretty much an overview of Eustis. Here's some other, just kind of another look at of what's happening. You can see, and all this data is on your dashboard, right? So every month you're going to have this information, but you can see when we opened in May, we quickly climbed to over 50% occupancy to end September. And our goal is to get the facility to 62% occupancy by the end of October. And you're probably thinking like, okay, well, what's the so what here? Why does this matter? Well, if you think about, we actually did not expect to be at 80% occupancy in 2025. In fact, we really planned to end the year at about 30%. So with this trend here, as you can see, we're actually leasing up this facility quite faster than we had anticipated. So what this means is that if we lease up the property faster, we can do those ECRIs or the rent increases quicker, and then we can actually stabilize the facility and not have to use as much cash that we put in reserves to stabilize the property, which means it's going to amplify the returns to the investors, assuming that we keep these trends, right? I don't want to say that the game is over yet. We're in the second quarter and we're up by 21 points. There's probably a low likelihood somebody's coming and catching us at this point. There's a high likelihood that we're going to win the game, which is lease up faster, have really good NOI, and really good returns to investors. So this is really good. Some things that we've noticed: snowbirds came down to Florida a little bit later this year. Not a big concern, but just an observation. And we're also evaluating adding 17 parking spaces. One thing that has been overwhelming from the customer is that they want parking. And we've optimized the facility in a way that only has self-storage, but then we also have this excess land in the back that we're looking at the NOI, or the ROI, I should say, on converting that into parking. So if we can add more parking, that just serves as a additional upside to the investor that wasn't contemplated in the offering at the beginning. So a lot of really fun stuff happening here. I was pretty happy with the way it's turned out. And you can see the one more thing I wanted to kind of explain is the line in rents per square foot. You can see we've declined the rents per square foot to drive the occupancy up, right? So we want to have we want to have promotions, we want to have move-in specials. We want to get people into our facility because we know they're going to stay on average 32 to 35 months, and we're still going to get some value out of that customer by having them move in. And then once we get stabilized, we can start optimizing the rents. And you can see in August, we've started to do that. We've started to increase our asking rents or our street rates to a higher cost. And we're like kind of tweaking that balance of how much do you cost, how much do you increase initial rents with keeping the occupancy momentum going. And so the team does a really good job of daily kind of monitoring that to make sure that we're going to lease up the facility efficiently. Just some other trends. I'm kind of diving deep into this property, but this is a little bit incomplete in that, we really haven't had that much operational performance on the Eustis asset. And then just some market data. These are just, I'm not going to go through this on every single property, but just some market data to kind of show you what we look at to monitor your assets, right? So in this case, Eustis, you can see the population growth in green, 2.22%. That's annual population growth. You can see the median household income is a little bit below what we want, but $64,000. And you can see the unemployment rate, the traffic count driving by the property, and then we score it based on the colors, and you can see the market tiering that's down on the bottom right. The other thing that we look at is saturation rate, and I can spend a lot of time here, but I just wanted to introduce the concept of, in 2025, you can see that our saturation rate at this facility is a 12. That means that in the market surrounding this property, there's about 12 square feet being consumed per person as an average. If we kind of consider, sort of back of the napkin, a balanced market to be about 7 to 9 square feet. But that data point, that statistic doesn't hold up all by itself. You actually have to dig into the market a lot more, and you have to understand your competitor occupancy, their rates, restrictive zoning, things like that. So you can see that in 2025, the square foot per person is 12, which is a little bit on the high side. But again, we're getting really strong move-in rates. So that's not the only telltale sign of a performance. But most importantly, you can see that the saturation number is getting lower in 2030. And what that tells you, one or two things or both, which is there's no supply of future self-storage developments that would cause that number to increase. And it also tells you that the population growth is actually lowering the square foot per person. So that's a good thing. That's a good thing that number is going down, because it means that there could be more future demand for this property. Long term, we want to sell this property. We want to sell this property, long-term outlook. We think that this is the perfect market to where the word gets out and people start building more facilities. So the name of the game in self-storage, to be perfectly honest, is when you find a market like this and it leases up very quickly and you can kind of get what you want, you got to kind of close the door and pack up and sell this baby and move on. Because in a market like this, where while you can't build around the 3 mile market of this, people will catch on that this is a good market for self-storage, and you'll start to see people coming in and starting to build. So it's a great opportunity in the next 2 years, lease up this property, stabilize rents, and put it to market to sell. Athens. Now I don't have full pictures for all these, but the Athens facility, our original business plan was to buy 30,000 square feet, and then the seller was going to deliver another 70,000 square feet, and our contract was written as such. So we bought the 30,000 square feet. We got that lease to about 80 or 90%. And just as we were starting to run out of units to lease, the seller delivered the remaining 70,000. Now, the timing was almost perfect, but the seller was late contractually in delivering those units to us. And so because of that, we had a damages clause in the agreement, liquidated daily damages of $500. So because he delivered it, I think 60 days late, we collected $500 per day for the time that he didn't deliver the additional 70,000 square feet. And then that reduced the sales price of the facility. So the Athens property actually got a little bit better. Because of that delay in delivering the extra 70,000 square feet. However, he's delivered those buildings now, and you'll notice in your reports that you'll see occupancies up in the 70s or 80s, then all of a sudden it goes down to like 20 or 30%. And that's because we added more units in inventory. So as a percentage of the inventory now went from the 30,000 foot property to 100,000 foot property. So you'll see that has declined, but overall, lease up is going just about as well as we expected it to. And we expect this to be on the pro forma that we projected, with distribution starting in 2027. Beaufort, moving on over to South Carolina. We have good rental rates. Occupancy is bouncing around. The public storage, the operator is adjusting rents. So they're slowly bringing up rents to market. And we still do plan on buying 2 additional assets to add to this offering. And there's a webinar on that. In both properties, those 2 additional assets we're actually going to move to CubeSmart, who's done a great job. And the distributions have been consistent. We plan on closing those 2 additional properties in the February timeframe of 2026. We've renegotiated with the seller a $2 million price reduction. So we were ready to close and then kind of got into due diligence and decided that we needed a $2 million price reduction. They agreed to that. And then we plan to close on this investment in the new year with the new pricing reduction on the properties. Chattanooga, so the Hickson Pike investment opportunity. This is a facility that we have that's extra space managed. The plan was to take this from Storage King, rebrand it into Extra Space, and drive performance. And so if you look at the P&L, there's been quite a lot of month-over-month NOI growth, which has been great. And they've been doing it at an 80% occupied rate. So they've been moving out the lower paying customers, moving in higher paying customers. And we've really benefited from being in a market where there's 3 other Extra Space facilities within a 5-minute drive time, because pretty much the only option for Chattanooga is to be at Extra Space. And sort of joining the competition has really benefited this investment. Distributions have been consistent, and we don't expect that to change. The Salem investment, also managed by Public Storage, similar to Beaufort. We've been trending up in rents per square foot to finish the year. And then the market's been well occupied, and the fundamentals for storage have been good. Really much to add there. There's been, we had a planned capital improvements budget of, I think, of about $700K or something on that facility. We've started to execute on those capital improvements, but there really hasn't been any changes. We did evaluate putting in additional self-storage, but those have just been sort of in the back of our head, what we're going to do. That was part of the business plan. So we really have to kind of think through our capitalization structure for that, how we would, sort of bring on additional money to build additional units. But for now, we're staying the course on parking in that area and just really taking advantage of the Salem market. White Sulphur Springs, I just checked occupancy this morning. It's about 36% occupied. And so the leasing has been happening pretty much on target, maybe slightly ahead on the number of move-ins, and maybe just slightly behind in the revenue per move-in. And so we've been leasing, again, when we lease up a brand new facility, and in this case, we bought an old shoe factory, we converted it into a self-storage, and we're taking it from 0 to lease up. And we're going to end the year at about 40% occupancy, which is about expected for a facility. It takes about 2 years to lease up a property, so it's pretty much right where we expect it to be. And then we're doing a lot of local marketing for this property. So overall, I wouldn't say there's anything exciting here. I would say it's kind of going exactly as we sort of anticipated and planned. Northwest Arkansas gets a little bit more exciting in Northwest Arkansas. This is a market where we bought 3 self-storage facilities from a mom and pop owner, and they were really run down. So it's called AJ Storage, leaky roofs, no marketing, no online website, and positioned in a market where there was literally no REITs. So there's no REITs in the market, no publicly traded self-storage operators. And we bought this earlier this year with the expectation that we would introduce Extra Space to the market as our operator, and we would take these properties from a rundown ragtag mom and pop operation and turn it into a publicly traded storage company level of operation, and watch them and see what they can do in this market, and over time go from a $9.50 market per square foot to maybe about a $12 in square foot market. And they've been doing exactly kind of as we expected. We expect distributions to begin in Q2 of next year, right in line with pro forma. And if you look at our reported P&Ls, we're growing NOI. The last 3 months of the year, they've gone up about $15,000 month over month, pretty consistently. And that's just because of our positioning in the market, backed by the fact that Bentonville is one of the 5th fastest growing cities in the nation. So we have this amazing, opportunity here to continue just growing in a market. As an aside, privately, one of the properties actually, we got an off-market offer to buy one of the properties from the Walton family. So the North property in Bentonville is actually in the path of progress. And so the Waltons want to buy up all the land kind of surrounding that corridor so that they could make some really beautiful developments and investments into Bentonville, home of Walmart. And so I actually have a friend that works with the Walton family that knew that we had bought this portfolio because he's on our investor list. And he said, "Hey, I know that you bought these, so here's an offer." And so they offered to pay us $1 million more than what we had paid for it about 2 months after we bought the facility. The reason why we declined it is because there's a lot more room to run, and you never swing at the first pitch. I came back and basically just said, "Look, if you can hit our 5-year target exit price right now, we'll sell. But otherwise, we're going to sit back and watch this thing, become way more valuable over the next years." And we did some internal IRR calculations. It just makes sense to wait. We actually, another kind of as an aside, the broker that brought us this deal is invested $1 million in this deal. So I actually called him and said, "Hey, you're an investor in this deal, and you're the #1 storage broker in the country. What would you do?" And got some really good advice to just basically stay put and let Extra Space continue to do what they're doing in this market. If you're in the growth fund, we also rebranded our 4th property in this market, separate deal, but in the growth fund, in P Ridge into Extra Space. And that one has also been seeing top line revenue grow from about $70,000 per month to over $85,000 per month in the recent financials. So pretty good overall. All right, and let me see if I can share. I'm going to stop sharing for a second and see if we can't get computer audio into this, but I'm going to. Okay, maybe I can't, but we actually, when I talk about Bellingham, I wanted to share the audio, but maybe we can all just read. Can you guys hear this okay?
Hey everybody, it's Ron Gibson with Spartan Investment Group, and we're excited to announce the groundbreaking of our self-storage facility right here in Bellingham, Washington. We're going to kick things off in 3, 2, 1, let's go! So even though we're celebrating the groundbreaking today, we actually have been working on this project since June with an expected delivery in mid-summer. Let's walk around the site and check it out. So one of the first things that we had to do with the site is we had to completely clear and grade. Now, here in the Pacific Northwest, sometimes the land isn't the best quality soil. So we actually had to come in and scrape about 18 inches to 2 feet off this entire site and remove a lot of the bad dirt from this location. Now that process takes a month or so, and that part has been now completed. So you can see now we're putting in the structural fill into the site and getting it all to a finished floor height. And that provides us with a really nice smooth terrain here so we can start setting our building stakes and getting our foundations put in and eventually pouring our concrete so we can go vertical on the buildings. We're doing all this with the hopes of getting it all done before the heavy rain season so that we can get dried in and start putting up our buildings and working on the interior during the heavier rain season in this area. So what we have here is the capillary rate, which goes underneath the foundation. So the crews are actually going to put this where those foundation dig outs are, and that's going to prevent moisture from coming up into the foundation. This is what's called a catch basin. So we've done all of our underground storm systems. So when it rains here in the Pacific Northwest a lot, you need the rainwater to go somewhere to retain it or control it. And they have catch basins all over the site. You can see I have one here. We also have one over on this side of the property as well. And you can see that we have our storm system over my left-hand shoulder. So all the underground utilities are going in. We've got our storm system. Then we're going to start getting ready for our first few concrete pours before the winter really sets in. One of the things that we have to do is put electricity on the site. So right now we're getting ready to build our electrical room. And this is where the power is going to come in from the street. It's going to go into the electrical room. And this is going to then go to all the buildings. So what the guys are doing now is they're putting into the conduit lines, and they're going to run these lines underground in each respective building. So every building is powered. And you can see the outline of this room. This is going to be what's called our electrical room, and that's going to help energize our facility. Okay, I got the black bag pulled off. This is our fire hydrant, as you can see. City of Bellingham requires them to be red. Sometimes you'll see them yellow on construction sites, but this site requires them to be red, old school. And you can see it's actually got a 6-foot pipe that goes into the ground that connects into our utility system. And you can get a sense of how much dirt is going to be pushed into this site. I mean, this is going to be level with our asphalt once our asphalt gets put in, and getting this site to a nice, smooth, even surface. And as you walk around the property, you'll see multiple fire hydrants so that we're dialed in with the fire department and up to code. So I'm standing actually inside one of the buildings in the future. And you can see the markations on the ground here, the building stakes that are coming in around me. And you can see that they're digging the places where we're going to pour our foundation footer for the building. We broke ground back in June. We plan to deliver this site in mid-2026. The crews are out here. We've had the entire site excavated. We've started to mark where our building corners are going to be. We started to dig the foundations. We've got a lot of our utility work done in the ground. We've started to do things like stormwater, catch basins. We also have an electrical room going in. All the conduits getting run for the electrical. And we're well underway in this project. The next thing that you're going to see in the progress updates of the site are going to be things like pouring foundations for each respective building, coming in and clear and grading the site in a way that allows us to eventually put in asphalt. You can walk around the property and see our fire hydrants. You can see our catch basins. You can see all the work that's basically gone into this. And we're very excited to give you this update, but we just wanted to thank you for walking around the projects and investing in the Bellingham opportunity. We'll catch you on the next update. Thank you.
Okay. So that's Bellingham. That gave me a little time to drink a sip of coffee. So, but that's been going very well. So Lake Stevens, going a little further south of Bellingham, we took over the asset in the midsummer time frame. Rents are being pushed to market as the current tenants are underpaying, and basically we're kind of moving out lower paying tenants. And distributions are on time and expected to remain consistent throughout the rest of the year. So not a lot to report there. Pretty easy property. It's a value-add existing facility in Lake Stevens. So we rebranded it. We took it over. We put in our automation and trained our employee. And they're an A player at the site from my operations team's notes. Okay, so Houston, we're getting to the end here. So Houston, early performance ahead of projections. So specifically in September, our revenue was $37,000 per month higher. In October, the monthly performance ended about $11,000 a month higher than targets. And then you probably saw the note but we also negotiated with the lender an automatic earnout of $14 million if we achieve our performance targets. So all that means to you as the investor is that in 3 years from now, between month 33 and month 37, we have a window of time to where if our performance is hitting a 1.35 DSCR, basically it's just an easy way of saying, if our monthly income that's generated, our monthly loan is $1 per month, we have to generate at least $1.35 of income, right? So as long as that is continued, and that's what's projected, then the lender basically increases the amount of money that they lend to us. So the loan goes up, never exceeding a 60% loan to value, but that money then is passed on through to the investor so that you would recap about 24% of your investment if we hit those targets. So that's exciting. And CubeSmart is in the building. We're down there with Mr. Lemmer in, when was that? September, I think. September or October. We went through a couple of the new buildings, and CubeSmart is in there doing their thing. So overall, pretty excited with the way that it started. And for those who invested in Houston, in July, they got their first distribution check on November 1st, and then for those who invested in the August timeframe, will get their distribution on December 1st. So distributions have started for Houston based on when you invested in the deal. Okay, so our outlook for 2026, we did a tremendous amount of tech rollout this year. And I'll show a video of that in a minute. I'm not going to spend too much time there. But basically, we want to expand our optimization. We're doing monthly P&L reviews of all of our portfolio. And basically just disciplined growth. We're probably not going to buy as much as we bought in 2025 and 2026. We're probably going to have that a little tempered and just really wait for good market deals to come out. The competition has eased a little bit, so we were able to kind of get to the table on more deals, which means we can be a little bit more selective. So that's our plan for 2026 overall. What we expect, and tailwinds wise, we expect interest rates to fall. Unfortunately, so does everybody else. So a lot of the new loans that we're getting right now are already baked in. Right, so the Houston loan and the Rockies financing, and even the Kings Bay financing, those banks already have priced in the rates being cut by the Fed later on this year. So what happens beyond that? I don't have my crystal ball, but I will say that any tailwinds that we can get in it being cheaper to move or being cheaper to buy a house will only impact our portfolio positively. So, a lot of markets that we're in, we're seeing robust growth and revenue. Some markets that we're in, we're seeing flat to slightly increasing revenue based on market factors. And so really all you can do is go to your expenses, right? So get more expenses. And, my mentor always told me there's no such thing as a fixed expense. You can always cut your payroll. You can always renegotiate your utility contracts. You can always lower your expenses. You have no such thing as a fixed expense. You can always change those things. So that's what we're doing. We're going through and ripping apart contracts, renegotiating pricing. One thing that we did earlier this year, which was exciting, is we actually created our own tenant insurance captive program, which is going to increase the splits on our tenant insurance premiums going into the new year. There's a lot of things that we're doing just to make sure that we're being as efficient as we can, absence of being able to grow revenue in some markets. So overall, very, very pleased with how the team is doing and how we're positioned for any tailwinds and any headwinds. The last thing I'll say too is capital markets team is going through and they're refinancing everything that they can, and especially purchases over the last 3 years where interest rates are maybe above 7. We've taken a sharper look at refinancing. Anything above a 7 is going to get refinanced, or at least we're going to try to refinance it. Anything that has an interest-only period extending, we're going to be looking to refinance that to get a longer interest-only period. And in the macro environment for lending, lenders are hungry. They want to put cash out right now. They have more cash to deploy than they can find borrowers. And if you think about the phenomenon that's going on in commercial real estate, there's not a lot of transactions. There's not a lot of people buying property, which means these lenders don't have a lot of money to loan to new acquisitions. So where they're spending a lot of their time right now is either extending loans or refinancing loans for different operators. So that really opens up an opportunity for us, and we've already taken advantage of it, specifically refinancing 3 properties in the Spartan Storage Fund 1. And also we're about to refinance 3 properties in the Growth Fund in the St. Mary's and Kingsland market. And then we're also looking to refinance the DFW portfolio into about a 0.5 point cut in rates. So a lot of tailwinds with, sort of lenders having nowhere to put their cash, but needing to put out cash to stay in business. Not going to really talk too much about this. I think we've kind of covered this quite a bit. But before I go into the Kings Bay investment, does anybody have any questions or comments?
Ryan, you said that going forward, you don't see as many transactions occurring. Are you hearing the same thing from, the REITs or Blackstone or any of those guys? Is that kind of what they're saying? I'm reading where, not necessarily self-storage, but they're starting to see commercial real estate as being more attractive again. Are you hearing anything? Can you comment on any of those things that you might be hearing now?
Yeah, so I would say the REITs are active. They are buying. I would say that the Extra Space originated about just shy of $1 billion in loans in 2024 to their operating partners. So to say that they're not investing, maybe they don't transact a facility purchase, but they've financed one of their operating partners' properties to the tune of about $1 billion. So the REITs are deploying cash in the market. Public Storage has been a steady, active buyer. They've been at the bidding table with us on a lot of properties. But you sort of get into this every year in the fall. You get into this, the brokers, say there's a lot of things coming to market. I don't know how that bid-ask spread is going to be. And so until we kind of see that coming more in line with where rental rates are and what the forecast looks like, I think from a Spartan side, I don't see as many transactions happening next year, unless something drastically changes. I see the REITs staying very hungry and still continuing to buy and consume properties. And so there's a lot of positivity, there's a lot of positive market sentiment. But as far as, people coming to the table to buy, I just don't see as many transactions, kind of a flat year for transactions in 2025. Kind of like what the housing market did, I think, over the summer, which was we saw a lot of inventory, but not a lot of buyers. I could see that happening. And then I see a lot of extending, I think the extending loans. I think in commercial, sort of the sentiment right now is extend and pretend. People are extending out their loans for a longer extended hold period, and not selling because of the market that they find in to not be the best selling time. And so I think there's still some really good opportunities to pick up discounted pricing on these assets. So.
Right, on a percentage basis, what's the split of climate controlled versus non-climate nationally?
Nationally, I'm not sure off the top of my head. If I had to guess, probably a 60-40 split.
Of non-climate.
Yeah, more non-climate than climate for sure.
And how are you in the markets where you've got properties right now? What's your ratio of climate to non-climate? Comparable to what's in the market? It's higher or lower?
Pretty comparable. I mean, I think what's really important about climate and non-climate, I think investors tend to get a little bit hung up on that, and it really depends on where you are. So, for example, In the PNW, there is no difference in pricing between a non-climate unit and a climate unit. So if you were to put air conditioning and ventilation and all that, spend that money, you wouldn't get another dollar for a conditioned unit here in the PNW. Now in Texas, you might spend that money and you might get an extra 20 or 30% for that same unit, but it's also going to come at a cost, right? Of, CapEx budget for replacing HVAC systems, running utility expenses, insulating the building, and dealing with that, right? Added cost of electricity, et cetera. So
yeah, the reason I was asking that question is because in your growth rates, you showed, I think, a 1-point spread different between the two. So I'm wondering if, there's opportunity there based on that,
yeah,
or is
yeah,
it just
absolutely. I think it's really market dependent.
Okay.
And sometimes the stuff that we buy, we don't get the choice, and obviously when we build, we get the choice. So we've done a good job, I think, of kind of right sizing, right sizing the unit mix, especially on new builds.
Other question is on notice for rate increases. What's a typical time frame?
30 days.
Okay, thank you.
You're welcome. Alrighty. Well, I did want to kind of wrap with a quick investment overview of a deal that we're doing that I think you guys want to pay attention to and be part of. That's in Kings Bay, Georgia. And I think what's really neat about this market is about 2.5 years ago, we bought our first facility here. And this is just north of Jacksonville, Florida. And it's in a market where we already own 3 properties. And so the first property that we bought in this market was the Kingsland property. And we bought it empty. A contractor had just built it and we had just started to lease it up. And the property leased up to 100% capacity in under a year. So it's literally one of the best markets that we're in. Later on, there was 2 properties down the road that the sellers came to us and said, "Hey, look, we don't want to compete in this market with you guys anymore. We want to sell." So then we had 3 properties in this little market. And then this Kings Bay opportunity is the last property in St. Mary's to the east, where we will have total market domination. And so, when we went down there, when we first bought the first few properties, one thing that we really loved is that there was a lot of housing going in, 3,800 homes, and a lot of population growth. And we really have, with the 3 properties that are already there, adding this 4th one really gives us a competitive advantage for scale. And what I mean by that is we have a manager there that's only been there for probably, a couple of years. She's already gotten 250 reviews, 5-star reviews, and she manages all the sites. And we've really taken advantage of the marketing scale, the payroll efficiency, and just having properties within 5 minutes of each other. It's been really good. This market's over 95% occupied. So the investment that we're doing is literally just our classic take the rents to where the market is. And our competition is ourselves. So we literally don't compete with others. We know what we're charging. We're charging about $15 per square foot at our other facilities. And this owner is charging about $10.50. So we're literally just taking this 95% occupied property and raising the rents to what we're already charging as a business plan. The broker that's facilitating this transaction, we've basically told them our plan is simple. We're going to target a 5-year hold. But once we buy this 4th one, we're going to get the rents up to where the other ones are, and then we're going to sell this entire portfolio. So there's some institutional upside in the fact that we have a really well-defined exit strategy, and that we basically took over the whole market, and we're going to sell it to a regional operator or someone nationally that would really benefit from buying a $35 to $40 million portfolio in this space and having the scale that we have.
How many total units?
You took the words right out of my mouth. 484 right on the screen. So It's 95% physically occupied. This is a nice climate, non-climate split. And there's some boat and RV parking as well, about 68. So that kind of gives you an idea. So it's kind of funny, built in 1985. So back in the 80s, you know, when they built things a little bit tougher than they do today, in my opinion, they built this out of concrete masonry block. And so one of my investors actually drove down there to the site and looked at the property, and he goes, "It's a fortress. It literally looks like a fortress." So very well secured location, very good site. Now, kind of sad to say, but it's right next to an old airports that I like to fly to. So if you see this this property here, this is our property, and you can see that gold shaded area is an old runway. And so unfortunately, a lot of these old runways are just not conducive, and they don't really contribute all that much. So the city sold off the runway, and they're redeveloping it into a commerce park. And Pigmental Studios announced a $200 million complex right there, right adjacent to our property. And Pigmental Studios is the company that produced the movie Despicable Me, and they're literally going to be our neighbor, which is pretty cool. And this market has a submarine base that's right nearby. It has, you know, like I said, 3,800 homes moving into the area. And now it's going to have a pretty big labor development, you know, right here on our site. Traffic count's lower than we anticipate, but that's okay because we have overflow from our other storage locations. Our other storage locations are completely full. And this market's kind of a small market. It's not a huge market, but it is growing quite a bit. So these are kind of the three properties that I mentioned. So you can see on the top left of the map, that was the first one we bought. We leased that up to 100% in a year. Then the other two facilities in St. Mary's we bought from a different, all under the growth fund. And then the property that we're talking about is right there at Kings Bay by the old airport. So market occupancy is well over 90%, high performing. It gives us immediacy. And I'd say each property is within 5 minutes of each other. So we already have a team on the ground that's been, you know, performing really well. So we own 3 in the market. I talked about that. This is kind of just a repeat of what we talked about here. But really, one thing that's kind of exciting is just the operational excellence that we're going to get out of running these sites. I mentioned earlier, we opened this property. So in the 2 years we've owned this facility, the manager has got a perfect 5-star Google review. That's incredible, especially when there's 274 reviews. So our team is world class there in this property. Then when we took over the St. Mary's site, 12 5-star reviews. We just recently took those over, and 58. And a lot of those reviews were from the previous owner, or they were just complaining that we raised their rents. So good customer service, good operational excellence there. But I would say the big advantage is this. So you notice this, and I talked about the technology that we've been rolling out in our facilities. If you notice, we have our Store Ease technology here. And so I wanted to show you what this does and how we've rolled this out. But this is going to be in the Kingsland market, the St. Mary's market. So that's going to benefit this investment. People are going to be able to book units, talk to a manager, regardless of the employee being on or off the site. And this makes our payroll way more efficient while keeping a high standard of customer service. So I'll show you a video and kind of just show you how it works.
And something that we're doing throughout our entire portfolio is we're installing a digital screen. Think of this as like an iPhone that's 10 times larger than the one you have in the facility, where when you walk in, someone in our call center greets you on the screen within 3 seconds. And I'm going to show you a demo of that. So right now we don't have any employees on site. We have no one here working, but we are able to actually remotely open the office from our headquarters in Colorado. And that lighted open sign actually will turn on remotely. And then off hours, we can actually turn that off. So let's check it out and we'll see how our Store Ease automated system works. Let's come on into the property. So our door is actually remotely controlled, open and lock, and we'll show that. I'll talk about that. But as soon as I open this door, it's going to trigger our Store Ease manager coming online. So we're going to walk into our office.
Virtual manager. Virtual manager.
So here it says virtual manager coming online.
2, 1.
And here we go. How's it going?
Great.
Good.
How's it on your end?
Good, good. I just wanted to demonstrate our Story Ease booking system. So we actually have multiple facilities that cover different properties, and we're able to completely book a unit online. Can you kind of give us just a brief overview of some of the things that you've learned from Stories and some of the benefits that you've seen so far?
Well, it is quick. It is very convenient. There are about maybe 5 of us who actually run the Story Ease properties. So it's very manageable.
That's great. Yeah. So basically we are able to run our stores without an employee here all the time. And we also have the ability to book units more hours spread across the portfolio. So it's a very efficient way of doing that. Thank you so much for your time. Appreciate it.
Awesome.
And something that
that kind of gives you an idea of how that works.
is we're
Let's see how can I get to the 1 second. There we go. Okay. So just to kind of give you an idea of demographics. So one thing that we look at for demographics is population growth. And so 2% is sort of the excellence in the industry. And you can see that we're at 3.6% within a 3-mile ring. That's really good. There's a lot of people moving here. You can see the household incomes at 90K within 3 miles. That's excellent. I would say on the low end, it's like in the 60s or the 50s. The high end, you could probably see it get under the mid 100s, but I would say a $90,000 household income market is really good, especially when you consider that people can allocate a percentage of their income to that, to self-storage. So we really like that. 3-mile market and 5-mile market's pretty strong at 13,000 and 25,000 and growing. I really see this as a market that's going to fill up. It's going to be a market that has steady population growth, multifamily coming in, and the need for storage is just going to continue to play out. This is our business plan, right? So this is our, on the very left-hand side, that's our current facility rent at Kings Bay. Now that gold bar line is the average price that people are getting in this 90% plus market. So people are getting $13. Our facilities that we run are getting about 15. And so all our business plan for Kings Bay to do is just to bring our rents up to what everybody else is getting over a 5-year term. Now this could happen faster or slower, but this is the way that we've kind of built in our financials. And so if you look at the year-over-year trend for a Class C investor, you can see that the way we're projecting your cash flow, starting at 5.6%, growing to year 5 to 6.9%, is by bringing the rents to market slowly and incrementally and strategically, so we don't scare everybody off, but also that we can continue churning customers to higher paying rents. And now you notice in year 2, the cash flow goes down, and that's because the loan amortizes. So that means that you're just getting the benefit of the cash flow on the backside of the deal. When it goes to principal and interest payments, that happens after 12 months. And then after that, we kind of grow back to where we were in cash flow. So this is based on a Class C investor investing $1 million, which is what the Foliage members get for having an aggregated capital raising pool that you guys have as a club. So so when you look at the offering memorandum as a Foliage member, you can kind of look to the Class C investment as the indicator for projected returns. This is just kind of high level, 5-year target hold, 18% annual returns with a 1.91x multiple over 5 years. And we're planning to put down a 44% down payment of cash. And then we're borrowing 56% loan to value. And this is the fixed rate loan that we're putting on the investment with a 12-month IO, and then it goes to a 25-year amortizing loan after that. And then this is where the capital comes from. I like this slide a lot. It's about a $7.5 million deal. The purchase price is about $6.8 million with a $250K sponsorship fee, some closing costs, reserves, and then we plan to do improvements. Now the improvements aren't going to be things like roofs and electrical. They're going to be things like paint and drive aisles. So the improvements that we're making to this facility are going to be instant value add to the customer so that they can see that we're actually doing things that are going to make their experience better, which can help justify their rent increases as well. Okay, break-even occupancy starts at 54%, goes up a little bit when the loan amortizes, but then ends the investment at about 58% as we end our business plan. So break-even occupancy is anywhere from 54% to about 66%, which is really healthy for the investment. So to kind of conclude on Kings Bay, we have between $500K and $1 million left to raise on it. And so it's a pretty quick raise and a very small amount for the Foliage group to raise on, but it's a small deal in general. So if anybody wanted to participate in that, I'm sure Larry has the protocols for Kings Bay, but happy to ask any or answer any questions that you may have, and got the team here to kind of guide you through it. So thanks for tuning in, and thanks for being a Spartan investor.
Actually, Ryan, I don't think we received the offering memorandum on this one yet.
Okay, we'll make sure we get it for you. No problem.
Ryan, is this suited for SDIRA investors?
Yes.
Okay. And are you seeing any update or change in any risk involved with the SDIRA from the regulation perspective in this type of investment?
No. The one restriction we have is less than 25% of the investors, or no more than 25% of the investors can be self-directed IRA investors, but we're not even anywhere close to that threshold typically.
Mm-hmm.
We're usually under 10%. So what are you seeing this? Are you hearing of risks? Are you hearing of concerns?
Well, I had heard maybe 6 months ago some risk around the potential to have laws changed to where there were limitations around what you could do with SDIRA investments. And it seemed like relatively low risk, but over maybe, looking at the next term for elections and so forth, if my thought was if things swing way far the other direction, they could look at that. It's around taxes and where do you get your federal revenues from?
Yeah, I know that I think towards the end of the Biden administration, there were some concerns about that, and those kind of went away. So I'm not sure. I'm not aware of anything on the horizon that would be impacting it, but I could be wrong. So definitely do. If you hear anything, let us know.
Yeah.
So,
okay.
Yeah.
Thanks.
Yeah, you're welcome. Mr. Herman.
Yeah, hi, Ryan. In this 5-year deal, I didn't quite understand what you said. Has the 5 years started with the other 4, or is it 5 years from now?
5 years from now.
Okay. Thank you.
You're welcome.
When are you going to close on this deal?
December 15th is our scheduled closing date.
Any other questions? Otherwise, we'll let you go.
Awesome.
Well, thanks, Ryan. I think this was really informative.
Yeah.
Thanks, Ryan. Thank you.
Excellent.
We really appreciate your time, your support, allowing us to be involved with your group, and I hope, you feel the same about us. And, we look forward to growing together.
Likewise. Yeah. Thanks for having us, guys. Appreciate you jumping on. And if we don't talk, have a good one.
Thank you.
Thank you.
Thanksgiving.
Thank you.
All right.
Thanks, guys.
Thanks, guys.
If everybody wants to hang on, we can, we have our own discussion if you want. Be honest with you, I'm probably not the best person to manage the discussion here, simply because I'm starting to die from this still having the anesthesia in my system. So, does anybody have any questions that they want to talk about on it?
Why do you think we haven't heard about this before?
I had heard about it a couple weeks ago, but I never received any of the paperwork on it. So I think it was, I don't know. I just think it was a screw up that they didn't send me the, and it may have been part of it because I didn't follow up on anything from Tuesday on because I was, getting ready to go to the hospital.
I'm not blaming you, I'm blaming Andrew.
Right, yeah. It sounds like it's a $7.5 million raise and they only have a million left. So
Yeah.
they've been talking to somebody.
Yeah, somebody got it.
Maybe they have a broker that's investing a lot or something
Could be.
along those lines.
Well, when he
Could
talked to me originally, and this goes back 2 weeks ago, that there wasn't a big raise, that they had Ryan's friends from the YPO group, if you guys know what that is, he's got some very wealthy friends in that group, that they were going to, go into it, and they thought we could just go in with, with them. It's almost like a, such a small deal, but I don't know whether he's they've opened this up to everybody else or not. I have not seen a webinar on it, so other than what we just saw.
Yeah, for anybody who doesn't know that area, it's basically Amelia Island. It's hot. I mean, it was a little sleepy backwater 30 years ago, and now, it's becoming almost an escape area for Atlanta and also Northerners coming down.
So you're telling me we should have bought the land there instead of where we bought
Right.
it?
That's right. We went in the wrong direction.
Gabe, I think you have a question.
Not so much a question. I actually got notification for this about a month ago, back on October 8th. So I actually have a 100K already invested in that deal, and also have 50K. My sister-in-law invested in it.
Okay, so you already put in some into it, you said.
Yeah.
Okay.
That's they had a few investments, but I don't know. It's because I invested in both the Rockies one and also the Houston deal that I got these notifications from Ted.
That could be. It may have been they dropped the ball too by not sending me the information.
Larry, they mentioned a potential opportunity with Beaufort in February. Are you familiar with that? Is that an opportunity for Foliage or?
So yeah, so there's, I don't know, I'd have to go look, but there's a number of us that are in the one public storage location in Beaufort. There's two others. I visited one of them. I didn't visit them both. They're both like one of the Marine base training bases up there. I visited it. They originally had that deal, and they actually presented the offering memorandum. This would have been probably, well, it had to be July, and I went and saw it. And quite frankly, I called Ryan. I said, my wife said, Larry, you're really buying this thing? And I don't know if that was what caused him to to think differently, but they ended up renegotiating the properties, and that's now where it's coming back out. The one that we did buy in Beaufort, which is it's performing and it's actually paying as forecasted, was all owned by the same family. So this is the second and the third one in the portfolio. I don't know what the third one looks like. The one I did see, when I say what I said, I mean it was just not. Carol, you were at Houston. It wasn't Houston. It was more a traditional self-storage facility.
Yeah,
right?
maybe more like Northwest Arkansas, the mom and pop.
Yeah.
It
had a area in the front of it which was kind of interesting for truck parking, and they were using it for those food trucks parking, and they actually had the office was a food truck kind of broker or something like that. So that's what I know about it. I'd like to see what they have when they send out the new offering memorandum, because obviously things have changed.
Mm-hmm. Okay.
Beaufort, I can tell you, Beaufort is a South Carolina there. That's a very strong market. It's kind of like what Bob said about Kings Bay. It's that whole coast is growing, and Beaufort is just outside of Savannah and Hilton Head, and it's not far from that Port Wentworth facility that he started off the conversation that they just built the climate control. Maybe 45 minutes, maybe an hour from there.
But you are expecting them to bring that to Foliage
Oh yeah,
early next year. Okay.